Proud supporters of Africa this week. Engine, with us, you are number one.
As part of efforts to facilitate the ongoing demutualization of the Nairobi Stock Exchange, Kenya's Capital Markets Authority has released the proposed regulatory framework to govern the demutualization process for public comment. Paul Mwaye is CEO of African Alliance Kenya Management Company.
I think it's important in times that after a very long time we are actually seeing signs where the legislation that has been put in place is now coming to a point where we can expect to see, hopefully before the end of the year, the final demutualization of the Nairobi Stock Exchange. We've been talking about this for almost the last 5 years, and I think the signs are now, the writing is on the wall that this is finally coming through.
I mean, there've been a few blockages, and I think one of the most pronounced ones was what we saw in April when some stock brokerages were refusing just to comply. Effectively, they're the current owners, and it's them selling off their particular stake. Some issues around capital adequacy being shifted around and how they're going to be reimbursed. What's that all about?
Yes, I think in terms of how they are going to distribute the shares and who's going to get what share goes to government, there was a lot of blockages around that and a lot of conversation that went around about that. I believe that conversation is still on the table, but I think a lot of it has been resolved. And I think we are seeing clear signs that things will begin to go ahead going forward.
All right, it's still a while away. Effectively, demutualization paves the way for the Kenya Stock Exchange or the Nairobi Stock Exchange to list in early 2011. What does it mean when the stock exchange is also a listed entity?
Well, it means that the critical thing here is that you get the separation of the three functions, which is the management, the ownership, and the trading function. And which means now there will be separate shareholders in the stock exchange other than the stock brokers who are the current owners of the stock exchange. It is expected that this will bring greater transparency, greater accountability, and hopefully create a clear separation. It's not clear at the moment whether there will be further restrictions in terms of the ownership of the stock brokers. Right. I think India is a case where we saw stockbrokers being restricted to 49%. We are not sure whether that will happen in Kenya. So we're still waiting to see how that unfolds, but it is a clear sign and it is a beginning of what's expected.
A recent report in Nigerian media suggests that businesses in the country source only 1% of their financing from banks. We spoke to Kayode Akindele, director at JMH TIA Group.
Not that much, not as much as the government would like, to be honest. Most of the credit goes to a lot of the big corporations like Dangote and the multinationals, while the key drivers of the economy, which is the agricultural sector and the SMEs, are starved of funds.
All right, now obviously this is something that even the governor of the central bank has added his voice to, and often when he makes decisions through the MPC, it is really in view and in line with wanting to get more credit flowing into the real economy. What are the blockages? What's the problem here?
I think that two main. I think one of the issues is on credit. It's very hard to keep track of credit in Nigeria. We haven't got effective credit bureaus. I mean, in the last couple of years, some credit bureaus have been set up, but in ways of actually being to track debtors has been very difficult. So the cost of defaulting loans have gone up, and that's increased the interest payments people make. And also the lack of basic infrastructure. If you want to set up a business in Nigeria, you have to plan for your own power, probably your own transport network, and that adds to the cost of business. And so to make any business viable, margins have to be pretty high to get that into place. I
mean, you use the word the risk of defaulting, and this is really something that the banks have been quite susceptible to. The reason that you've had, well, not the reason, but one of the reasons you've had a financial crisis in Nigeria is poor capital adequacy on the parts of the banks and unbridled credit into key sectors of the economy, and then a lot of the lenders not honoring those loans. In the midst of these banking reforms, how are some of those problems being addressed?
I mean, the key problem is that the banks didn't do the credit work. It was very easy to, if you look at the debtors, there were mainly a small select group of companies and individuals in the upper echelons of society who were taking most of these multiple loans from multiple banks and using the same asset as collateral. The banks, it was easy for the banks to go in together, these big corporations, and do very little credit work for it, and they paid for it. I think in essence, when you look at the SME sector and some of the smaller firms, you actually need to do proper credit analysis and proper credit work on them. And the banks were loath to do that. I think a lot of the banks are really looking through their credit processes, trying to bring in more professional help in there, and trying to make sure that it's more thorough in what they do.
At a recent gathering of government and business in Nigeria, Wale Famurewa caught up with Nigeria's new Minister for Trade and Investment, Olusegun Aganga, and spoke to him about his new ministry's priorities.
Our key priorities are very simple. I think they've been set very clearly right from the beginning. We're a developing economy. We have a very ambitious transformation agenda, which means that we require heavy investment both from the local and foreign investment. So the whole idea of refocusing this ministry and expanding the mandate of this ministry is to make sure that we have a ministry that is proactively going out to attract investment into the country. And when I talk about attracting investment, I'm talking about expansion program in the country. I'm talking about foreign investments coming to the country, both from foreigners, both from the diaspora, and also looking at other ways of unlocking capital within the system itself. And the reason for that is very clear. We have a program that expects that we will invest about 35 trillion within the next 4 years. About 15 trillion of that has to come from the private sector. We know we have the opportunities here. We know we have the market here. We know we have the raw materials here. And the idea is to make sure that we have the policies and the laws that are investor-friendly, that make it a lot easier for both local and international investors to invest in our economy. So that is one of the primary mandates of this ministry. And of course, we continue to enhance and look at trade and trade also. Now, trade as defined by different people, there's a loose, tight definition, but we are looking at this from a broad perspective. And part of that involves not just increasing the volume of trade, but also using that as a way of addressing our import substitution program. So, for example, we export crude oil and cocoa to the United Kingdom. Yes, we want to do more trade in that sector, but I want to encourage the United Kingdom companies and investors through the Minister of Trade and Investment in the United Kingdom to get some of those companies, refining companies in the UK, to come here, set up their refineries in this country, where they can actually use the crude oil which is here, we have the cheap labor here, produce petroleum products in this country, produce fertilizers in this country, and have Africa as a ready market for them. They will make more money doing that. So we want to use that as not just looking at trade as in terms of volume, looking at that, but also using that to deal with some of our programs and initiatives in the country.
Okay, you just engaged the private sector in Nigeria in an interactive session. What were the key priorities, or should I say the major things that came out of this interaction?
A lot of good things came out of it. The first thing was that the attendance was fantastic. I couldn't ask for more. And these are real people who invest in the economy, who have significant investment, whether they're local or international investors. Now, so the attendance was very encouraging. The second thing was it was an opportunity for the Minister of Foreign Affairs and I to have a joint session to try and address the business community, to talk to them about how we intend to involve them going forward. So one of the key announcements or policy shift here is to make sure that on all foreign trips that we actively involve the business community. Actively, meaning that in advance they're part of the planning process. We know who is going. We have the names and bios of who is going with us. We know the sort of businesses that like us to organize for them on those foreign trips. We make sure we have a business forum or business meetings around such presidential trips, for example. That's one of the areas we all agreed we need to work together on. There are other areas where they go abroad, the foreign affairs is there for them, is there to support them, even when they want to invest abroad. So the idea is to say, look, this is going to be a partnership between the government and the private sector. They have a big role to play in expanding our businesses in this country. They have a big role to play in attracting foreign investment. They have a big role to play in policy shaping, in policy formulation. We want to seek their views so that we make sure that our policies and our laws are very investor-friendly.